All right, let's not bury the lead. You say there's one thing Netflix could do to juice revenues, grow subscribers, and get back on that growth stock trajectory. What is it?
It is adding an advertising tier, just like every competitor of it has. It is lowering its total addressable market every time it raises prices. So it just raised prices here in America, $2 for every single tier, and that lowers the number of people who can afford Netflix. That is insensitive to the consumers in this country when they have choices of free for Peacock and then $5 for Disney Plus, Discovery Plus, Paramount Plus. Like, there's a lot of cheaper services that have great content, and so Netflix needs to introduce a lower price tier to grow again.
How when you're talking about ad-supported, lower-priced, one of the things people like about Netflix is that there's no ads. How many ads are we talking about here?
So rich people like that. But I would say a lot of the country would prefer to have a $5, so like a 4-minute ad load, which would be 8 ads an hour, like Discovery Plus has, and then they pay $5. So it cuts the price from $15 to $5. That's a big savings.
Sure.
If the consumer can give up some of his time by watching ads.
So you mentioned the spending on content, and they spend a lot on content. They, apart from Disney, which is a different business model, really, they spend as much as anybody, maybe more than anybody else. Are you suggesting that they're spending too much, or do they have to do that to maintain the buzz, the edge that they have with viewers?
I think what the anemic subscriber growth showed in Q4, where they added 8.3 million subs, down from 8.5 million subs a year ago, even though they introduced 150 originals, their biggest content slate in history. What that just demonstrates is that the competitors are making inroads, that just spending money on content is not enough. And by the way, recall that Squid Games came out a week before this quarter started. And yet their biggest hit of all time was not enough to have them add more subscribers this year than last year. So content spending is no longer enough. And this company keeps spending more on content while competitors are taking their subs away.
Really interesting. Really interesting. Kelly.
Laura, I'm just curious if you think they should have gone into sports in retrospect, or if that would still be a good opportunity for them to pursue now.
So, yes, Kelly, I agree with that. I think you're either a go-to content app for consumers, or you're not. So the notion that you're arbitrarily going to decide we only do TV and film and we're not going to do news, which people care about, we're not going to do sports, which people care about, I think it's a flawed notion. They're either competing in the content business or they're not. And by the way, like Peacock and Paramount Plus both have sports, and they have awesome libraries that are 50 years deep. So eventually Netflix becomes a smaller and smaller portion of people's time, because once you're watching a sports, why not just stay there on Paramount or stay there on Peacock and just go watch some of their content there?
Is Netflix still a growth stock? And if it isn't, how do you value it?
It is not a growth stock, and the answer is it's a media stock, so it does not deserve its 8.3 multiple that it was trading at yesterday. It deserves a 4.5 multiple, which is where the Walt Disney Company trades, or a 2.1 multiple, which is where Viacom and Discovery and Fox trade. So this should trade like a media company and not like a FANG, not like Facebook and Google and some tech-backed monopolist.
And so if it were to trade at that media company multiple, it's $400 a share now. What would it trade at?
Under 300.
Laura, you answer questions. Love that. Thank you.
Thank you for asking excellent.
All right. Thank you very much, Kelly.